Welcome to Plotlines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acreveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together.
Welcome back to Plotlines, everyone. Today we are very excited to have David Auerbach, Chief Investment Officer at Hoya Capital, with us. David, welcome. And maybe you can tell us a little bit about your intricate history in the world of REITs and, your sort of love of REITs and your self-professed REIT nerd status. Just walk us through your history and what brings you here.
Sure. Thanks for having me. It's great to see you, Heather and Britni, and it's an honor to be here for this event today. My road down the world of REITs has been quite a path. I started when I graduated college as a regular retail advisor during the tech heyday, talking to investors about why they should be buying Microsoft or eBay. And an opportunity came along to visit with a high net worth prospect who wanted to have lunch with me, and my boss said that I couldn't. And I didn't understand why. And he said, you're mine during market hours. If you want to grow a book of business, that's on your time, not on my time.
Oh, gosh.
And I said to him, I go, that's the craziest thing I've ever heard. It makes no sense. My business is your book of business. If I grow, you grow.
Yeah.
Why don't you want me out there building this book? And he goes, I do. Just not during my time, during market hours.
Wow.
And I basically said to him, I go, that's the stupidest thing I've ever heard. Well, as a result, I got fired 24 hours later. And I was, back in the day when newspapers used to publish a classified section every single day with job ads, I responded to a 2-inch font, 1-inch line job post that said, have Series 763 call this number.
Yeah.
I called the number, and it wound up being to be a junior trader at a firm called Green Street Advisors, which is known as one of the preeminent REIT research firms. And this was back in the day when they used to have a trading desk here in Dallas.
Right.
So I joined Green Street in March of 2000 on the day that the NASDAQ bubble officially burst. And I got to watch the REIT industry grow up, talking to institutional investors, building relationships with a lot of these companies. And I left in December of 2011 and joined up with a local broker dealer here in Dallas in May of 2012 that focused on the world of exchange traded funds. They had a couple of REIT accounts that they covered. They were asking me to build the REIT book of business. But in the same breath, I was working on the world of ETFs as far as trading, marketing, sales, seeding, creation, redemption, all the fun intricacies in the world of ETFs. I was there for several years, and I left to join another broker-dealer out of Chicago, helping in the world of REITs, ETFs, new issue placements, et cetera. And in late 2022, I joined up with a firm called Armada ETF Advisors, which was launching REIT and real estate ETFs. Right. And in July of 2023, they decided to go in a different direction, where in September of 23, I joined up with Hoya Capital as the chief investment officer behind their 2 ETFs. The whole road, though, has led through one purpose, and that's education.
Yeah.
No matter what I've done in this industry, it's always about education. Helping advisors and investors and everybody in between understand why REITs are so important in a portfolio. And it's important to peel back the layers of the onion when it comes to some of these, call it doom and gloom headlines that we see every single day about, let's get to the real truth here. Let's figure this really out. And going back to that education thing, of course, I want everybody to buy our funds, buy our story. I understand that. But if they don't, that's okay. Let's figure out what the right REIT is, what the right ETF is for you, mutual fund, whatever, and let me help you make those introductions to these companies, because these companies, these funds, et cetera, want to engage with advisors and investors, and it's always about giving back, helping others, trying to educate about the whys of REITs.
And I've seen you do it a number of times, and you're a great connector in the REIT world. So we all thank you for it.
Well, thanks for sharing that journey, David. That's great. To your point, I guess let's peel back the layers of the onion, right? So our podcast is all about dissecting headlines in the real estate space. REITs have certainly had their fair share of fluctuation out in the press. So give us your take. I mean, certainly I think everyone's looking to see what the Fed is going to do with rate cuts here in the fall, but What's your take on what's out there now? Is it realistic? Is it giving the full story? Is there something that's missing from the narrative? We'd love to hear your perspective.
Well, there's about 200 publicly traded REITs that are out there across 20 different subsectors. Mm-hmm. Inside every single sector, there's a great story, and then there's obviously, concerns
Sure.
inside those subsectors. I think it's important to take a very holistic 10,000-foot view and understanding that, let's break it down. What is a REIT? A REIT is just an income pass-through vehicle. The income that a company generates is passed through to shareholders in the form of dividends. So at the end of the day, the end investor should be concerned about, what does this dividend flow look like? Mm-hmm. Do dividends keep going up? Does my bottom line keep growing up? There's enough research that's out there from REIT, that's the National Association of Real Estate Investment Trusts, Morningstar, and several other publications that talk about the difference in a portfolio that includes REITs versus one that doesn't. And add a layer to that, the sooner you can start investing in REITs, the more it carries down the line towards retirement. So one of the things I like to talk to advisors is, tell your client on the day that their child is born or their grandchild is born to go out and buy shares of monthly dividend paying REITs.
Right.
Because you could start that child on the retirement path on day one. Think about the amount of income potential that that person can earn over the course of 65, 70 years.
Yeah.
We use REITs every single day of our lives. We're using a REIT right now to have this conversation today.
Right.
And when we use these REIT-owned properties, we don't think about, gosh, where's the 10-year treasury at today? What's going on in the world of interest rates?
Right.
I can't go out and buy that cup of coffee because the 10-year treasury is trading above 4%. That's baloney.
Yeah.
We use these properties 24/7 in our lives, and it's just an easy way to investors to sit back and collect income. So I think that's part one. Mm-hmm. Part two, REITs today are different than REITs during COVID. If you think about what happened during COVID, where the mall shut down, travel shut down, hotels weren't occupied, et cetera, there was an overhang on the industry. Talk about office, work from home, return to office. All these headlines we see every single day. This commercial real estate wall of debt that's coming due. We see these doom and gloom headlines. But again, REITs are lumped into the whole world of real estate / commercial real estate. And unless you actually engage with these companies directly and have a conversation with them, the average investor might assume, oh, commercial real estate wall of debt coming due, that means all of these REITs are running into debt issues.
Yeah, makes sense.
And that's not true.
Mm-hmm. Okay, so is it a good time to buy REITs, David? And why?
So obviously I'm a little biased. I would say it's always a good time to buy REITs. But let's put it this way.
Yeah.
Where we sit right now, we're doing this interview at the end of August.
Yep.
The general consensus is that the Fed is cutting rates in a couple of weeks.
Yep.
My opinion, this is me not representing Hoya, this is my opinion. The market is already priced in a 25 basis point cut.
Right.
If the Fed only cuts 25 basis points, I think it's either going to be a non-event on the day that it happens, or you will see, let's call it an insignificant gain or loss in trading that particular day.
Right.
If they cut 50 basis points, I expect to see a rally in the market. But here's why this matters. Mm-hmm. REITs are generally considered an interest rate play, and we can get more into that. So when the Fed makes the rate cut announcement at 2 o'clock, at 2 o'clock in 1 second, the REIT sector should rally.
Right.
And at 2 o'clock in 2 seconds, the advisor is going to call his client saying, hey, the Fed has cut interest rates. It's time to buy REITs.
Right.
That ship has already sailed. If you look at the performance of the various REIT indices over the past few weeks, as I mentioned, you will start to see that the rate cuts are being priced in.
Right.
Secondarily, REITs are tied to the 10-year treasury, REITs versus bonds.
Yeah.
And the goal is that the REIT dividend yield should be wider than where the 10-year treasury is. And for the longest time, I said 4% was the magic number.
Right.
Well, we've come through that 4% number now. And so there's a spread between REIT dividends and fixed income that if all goes well, Dividends should go up while
Right.
the 10-year Treasury rate would go down as Fed is cutting rates.
Right.
Take a step back. Pick your favorite stock. It doesn't have to be a REIT. Let's use one for today. NVIDIA is announcing earnings after the close.
Yep.
And, we don't know what's happening. Obviously, by the time this airs, everybody will know what have happened.
Yep.
Right.
But if you're an NVIDIA investor, to really, let's say, get to the basics, you want the company to do 4 things. Grow revenues, grow profits, grow dividends, and grow its annual guidance or its earnings per share.
Sure.
If a company is able to do those 4 things on a regular basis, ignoring all the macro things that are being thrown at them, a la a rising interest rate environment, conflict overseas, et cetera, you would assume the company is on solid footing. And that's what's been happening in the world of REITs. By and large, most of these 200 companies have done those 4 things that I just referenced.
Right.
But because of all the other macro headlines that are surrounding it, it kind of gets thrown in together. One more point. It used to be, back in the finance college days when we were studying this stuff in undergrad, REITs would perform contra to what the market did. So if the market was up, REITs would be down. If the market was down, REITs would be up. It's that hedge to the general market.
Right.
Well, that's gone out with the bathwater come COVID. Now REITs trade in lockstep with the market, basically. And so whatever headlines that come out, the REITs kind of trade sensitive to it. But any chatter about soft landing, hard landing, anything with interest rates, housing data that comes out, et cetera, kind of lays back into the REITs. And that's why I think, again, it's so important to look at these companies on the fundamental level through their quarterly filings, their supplemental data, their earnings calls that they host, et cetera. And you can get a really good picture of how solid is the footing that this company is standing on.
Okay.
Yeah. That's interesting advice.
It is. So, I mean, there's so many, you talked about like 20 subsectors, I think you said. And all these different companies, right? You just addressed like I mean, there are obviously nuances that you pointed out, like the return to work, the return to the office, the oversupply in multifamily that is on again, off again, industrial data centers. You just mentioned NVIDIA. Like, talk about the different sectors in real estate and like the fundamentals that are supporting or difficult in those sectors.
Well, I mean, you've got the big ones, your industrial REITs, that's the industrial warehouses, apartments, retail, such as strip centers and malls, office, as we talked about. But then you've got all these other different types of sectors, cell towers, healthcare, self-storage, net lease properties like your gas stations, Walgreens, CVS, and drugstores. You've got mortgage REITs, you've got casino gaming REITs, the guys that own the Las Vegas Strip, single-family rentals, hotels, manufactured housing, timber, billboard, cannabis REITs, farmland, and then like diversified REITs, guys that kind of cross multiple lanes of the highway.
Sure.
There's so many stories that are out there. As I mentioned, the perfect example is Amazon.com. How many times a week do you order packages off of Amazon, or do you see Amazon trucks being delivered? Well, a big driver of that is this thing, your cell phone, the Amazon app on your cell phone. And if you order an Amazon package off your cell phone, you're using 3 different REIT sectors to get that order to your doorstep. The cell phone to send the order, the data center to process the order, and the industrial warehouse to get that to your doorstep. I don't know about you, but I don't think we're going to stop ordering Amazon packages anytime soon.
And you can return them at retail at retail locations now too. So there's a fourth.
Take it to Kohl's.
Another example, really from a different angle, you can think about how you use a REIT 24/7. You wake up in your apartment, you go get the cup of coffee, you drive on the tollway to your office. Again, we're using these properties every single day. Another example, going back to NVIDIA's data centers. Think about how AI has transformed our lives. And there's been several articles that have been published recently. JLL has done some research. Wall Street Journal published an article last week, but how AI is being a driver of data center development. So you've got Amazon and Google and Microsoft and Apple and all these other guys that are building data center properties, that this is just a sector that's going to continue to grow. But, you talk about office. office in New York is different than office in Dallas or San Francisco or any of these other cities. New York's a great example. It's one of the hottest rental markets in the country. People are moving back to New York in droves. However, New York is pretty much a 3 to 4 days a week in the office type of environment right now. And, I've been saying for a couple of years, great, people are moving back to New York in droves. However, when they wake up on Monday morning, it's time to go to work. Within 2 hours, they're going to kind of get cabin fever because it's like, I can't work in my apartment where my bed touches 3 of the 4 walls.
Right.
I'm getting out of here. So they move back. That's the first domino to fall. They go back to the office. That's the second domino to fall. And now all the retail that kind of follows people going back is the third domino. Separately, CBRE, which is a big commercial real estate firm, they're headquartered here in Dallas. They interviewed the CEO, or one of the top brass here very recently in Dallas, and they're like, what's it going to take to get more people to go back to work? And again, remember, it's different talking here than it is up in New York City.
Yeah, of course.
But, it's all about what amenities are you offering to your tenants to lure them in?
Yeah.
What's the commute situation like? Again, if you work at a property like One Vanderbilt, which is at Grand Central Terminal, you walk right out the door, you're at your property. There is no commute versus me having to drive 20 minutes to go downtown
of course.
to go work in an office building. I don't want to do that anymore personally. I'm in a different situation. I'm lucky I get to work out of my wife's store here and I have an office, but not everybody is so lucky.
Yeah.
However, let's take a bigger step back. Return to work. How has AI changed our world? Back in the day, Wall Street firms used to have what we call disaster recovery offices. And unfortunately, that was put in place because of 9/11.
Yeah.
Well, what did COVID prove? We don't have to have disaster recovery offices anymore because we can use TeamViewer and all of these programs to tap into our office computers, let's say. But part 2 of that, it basically showed that work from home is here to stay in some form or fashion. But think about something like a lab space REIT. That's another type of sector, life sciences. There's a big player called Alexandria Real Estate that dominates the sector. If you know what those properties look like, the white space lab, the how clean it is, because again, you can't have microbes and dust and all this other stuff. The cost to build these buildings is astronomical. But I personally think the cure for cancer, et cetera, is not going to be found by way of a Zoom conversation.
Right.
ChatGPT is not going to develop the formula to cure cancer. That's going to take in-person collaboration.
Right.
Yeah.
Building a house, construction, AI is not going to build that house for you.
Yeah.
AI is not going to see you as the patient going to see the doctor for surgery. The doctor may use a robot if you have to have surgery, but he's not going to type in a code, remove this person's appendix, go, and walk away.
Yeah.
We're always going to have this in-person collaboration. So I think it's important to realize that though we see some of these doom and gloom headlines, really you got to get down to the macro level here because, again, we're using these office properties, we're living in these apartment properties and renting single-family homes, et cetera, that regardless of what the headlines state, we're using these properties very regularly.
Yeah. And David, that bodes well to, we know you have a strong focus in the housing market and you've mentioned that a few times. What's your outlook there and how that drives investment decisions on housing-based REITs?
Yeah, and this goes back to pretty much some of the stuff I was saying at Armada. And unfortunately, not much has changed over this past couple of years. And you can boil it down to a couple of different points. Supply and demand. The demand to buy homes is so strong and there's just not enough supply out there to satisfy it. Number 2, home ownership costs are elevated. The average consumer can't buy a house right now. Or they're going to be taking down a 6 handle on the mortgage. There was great data that was published this week analyzing I think it was Redfin that published it, where like 9 out of 10 folks have a mortgage below, 5% or something. And those that have a mortgage at 4% or a 3% handle or something like that, they're not about to up and move and go.
Yeah, why would you?
Right.
That's issue number 1. Number 2, if you think about the future generations that are coming down the line and everything, there's just not enough at this point apartment properties to house these folks that are coming in. And so you're going to see continued growth of the apartments, growth of single family rental platforms, build to rent, rent to own.
Sure.
You know, unfortunately, there are cities in this country where people never get the opportunity to own a home because they can never afford it.
Right.
And until some of these home builders develop what I call a light product, instead of delivering a $700,000 home, you deliver a $300,000 home. You know,
like they used
going
to
be a gap. And so from where we sit, we still think there's, you know, a huge runway for growth when it comes to the world of housing, or even some of the other names that make up our housing fund. When you look at Home Goods and Furnishings, Home Depot, Lowe's, or the data providers, the Real Pages, which is going through its own issue right now, Zillow, Redfin, etc. You know, we take a very high level holistic view when it comes to housing, and we realize there is a long runway for growth for this sector.
Okay. So switching gears a little bit. So the REIT industry recently saw a massive IPO, which everybody was kind of excited about. What's your take on that? Not the company or anything, but like, is that an inflection point for the REIT industry? Was that the inflection point we were all waiting for, or is that sort of tied into the whole interest rate Fed discussion? What are your thoughts there?
I don't think it's tied to the interest rate Fed discussion. I mean, Lineage overnight on its IPO became the largest REIT in the marketplace.
Yeah.
It literally becomes number one. And if anything, I think it's a good sign that the enthusiasm is back for the REIT sector. It could be that turning point that we have hit a bottom. I don't know about other REITs in the pipeline to come public right now, but for how well it was received, it sure is an encouraging signal that people are looking at these companies again.
Yeah.
All right. Well, David, you shared so much here. We want to circle back to the question that we posed in the beginning, which was your perspective on current headlines. And now we want to give you the opportunity to write what your ideal headline would look like for the REIT market. So what are your thoughts there? What would that headline say?
REITs climb to all-time highs on the back of Federal Reserve interest rate cuts. It's not all doom and gloom in REITs, and here's why. Buy REITs for income. Don't buy it for the story. The list goes on and on. Look, for where we sit, I'm focused on names that pay the highest dividends with the lowest leverage ratios. I try to avoid some of these pitfalls and issues that we're seeing from some of these companies. And again, it goes back to what I started this conversation with. There's a difference between the publicly traded REITs and the private REITs. The headlines we see out of Blackstone and Starwood and some of these other guys that are out there, that public REITs are known for their transparency, as I mentioned.
That's right.
Earnings releases, conference calls, press releases, supplemental data, etc. They provide all the answers. And more importantly, investor relations departments at these companies are very accessible. Any investor or advisor should pick up the phone, call the company, ask them the questions, reach out to me, let me answer the questions or get the questions asked. They want to engage and educate. That's what it's all about. Because when you buy REITs, you have to use 25 to 50 year type of glasses when you own these vehicles. They're not day traded funds. It's not a single stock futures leveraged ETF like some of these funds that are out there. To end this conversation, REITs are boring. Boring is good. Slow and steady wins the race. REITs are the tortoise and the hare of your portfolio.
All right.
That's awesome. Thank you so much. This has been
Thank you guys. Thank you so much.
Enlightening as always.
Thanks, David. We appreciate having you.
Thank you.
All right. Well, that was another really interesting episode. I so appreciate David educating and informing us. That's what we're trying to do here as well.
So insightful. He's got, he just he's the REIT man.
Yeah, right.
You know, he knows everything. So,
and
really
just so our guests know, he also has his own newsletter, the REIT Beat newsletter.
So much like content all the time, just informative, straight facts. I follow it. I get all my information there.
Awesome. Yeah, I'm excited to follow along as well. And you can also connect with David on LinkedIn and Twitter. Sounds like he's a really knowledgeable resource for all of us in the REIT space.
Yeah, he's a great guy.
All right. Well, thanks for joining us today. We'll see you next time.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts